Good morning, everybody. Just coming up to 10:30 now, so we'll start. My name is Rose Kervick, and this webinar is part of our business growth webinars for Accountant Online. So we're very honoured to welcome Michael and Alan this morning of Wallace Corporate Counsel. And the subject of today's webinar is what founders should know about signing term sheets with investors. So we have about 80 people signed up to today's webinar. So those of you who aren't live on the call today will receive it anyway by recording, and all of the attendees will receive the recording also. But the benefit of being live on the webinar is you can ask your own questions. So please do put any questions into the chat that you have about your own situation. And those questions usually help anybody else that's on the call as well with similar questions. So thank you very much. So Alan and Michael, let's begin. What should founders know about signing term sheets with investors?
Yeah, thank you, Rose. Look, and thanks for the introduction. Look, just by way of background to everybody on the line, I'm partner and head of investments in Wallace Corporate Counsel, and we specialise in advising early stage companies from incorporation right through various funding rounds and hopefully onto successful exit. Michael is an associate on the team. He works closely with me on pretty much everything. He's my right-hand man, as some might say. Without further ado, what I'd like to get onto there first and foremost is what the purpose of the term sheet is. Okay. So like term sheets can be called a letter of intent, memorandum of understanding, but essentially they're the same thing. Okay. In its most basic form, what a term sheet is a summary of the key terms of a proposed investment with detail items such as the investment amount, timeline to close, key investor asks such as any consent rights, information rights, drag, tag, preemption rights, and the like. The rationale and the key item here is that it's to try and agree key terms in relation to the investment prior to both the company and the investor investing time, effort, and resources into the more technical aspects of the transaction and kind of progressing on to formal legals. So it's a cheat sheet to say, look, these are the terms of which we're willing to invest. And from the company side, they want to know exactly the terms of which, what equity they might have to give away, what the terms look like, such that they can kind of weigh up varying potential investors' investment term sheets. Typically speaking, the terms of the term sheet are non-binding, save for items such as transaction costs, exclusivity, which we'll both come to later, and confidentiality. But it helps to avoid misunderstandings and potential delays as the transaction progresses. Just to note to the group here, kind of certain kind of impacts of COVID that we're seeing on term sheets. Yes, there's a flurry of investments over the last, say, 9 months as kind of people have kind of come out the other side of COVID to an extent. But we're seeing far more seed investments or early stage investments being tranched. So that's, it's not all cash on day one. It might be part of the investment raise and on day one on completion, but a balance of it might be subject to agreed milestones. We're seeing more anti-dilution or down round protection from early stage investors. Principally, they were the preserve of maybe your seed raise or series raise. We're also seeing certain forms of liquidation preference rearing their head. And I'm not saying kind of aggressive double dip, not even single dip, but maybe just liquidation preference on a downside, just to give the investors a level of comfort early stage. Okay. So
Alan, lots of our participants today won't be familiar with many of the terms that you're using there. So this is just a little heads up. If you wouldn't mind just explaining some of those terms that you're using, I'm sure you will throughout the call, but I know there may be terms very familiar to you, but there's certainly they seem to be industry terms: double dip, etc., tranching. Let's keep it as practical, please, as we can. Just because many of the participants will be on the call because they don't know anything about this. So,
sure.
um,
Well, I absolutely will do, Rose.
okay.
Further down where we kind of delve into kind of equity versus convertible loan notes versus advanced subscription agreements and safes, I'll get into the weeds a small bit more on that. But all well noted there. What I'd say in kind of in plain terms, typically speaking, the earlier the investment, the more simple it should be. And the term sheet should help to keep things simple, such that typically we would have seen in the market over the last 5 years that for, say, a friends and family early stage raise or
Yeah.
an angel raise, it would be a subscription for ordinary shares, same class of shares as are issued to the founders across the board. So it's very, quite easy to distill. But just with COVID, we've just seen a greater appetite from an investor perspective to cover themselves in the unlikely event that the company either has to raise cash again at a lower valuation, or if the company is actually wound up before an exit. So we'll come to those. That's kind of anti-dilution or down round is just if there's a raise after the investor's investment at a lower valuation. Liquidation preference relates to another class of shares, a preferential class of shares that would be issued to the investor that isn't ordinary shares. And single dip, double dip, that relates.
Okay, let's not worry about them yet. But
okay.
But just highlighting, this is a really introduction to
Sure.
term sheets. Yeah. So
that's no problem. Look, we'll come to
thanks.
it. Maybe it's one for another webinar as well, Rose. But
or maybe a dictionary for us.
Sure.
But there's certainly, a lot of our participants were doing this for the first time. So just if you can consider us as absolute newbies here.
Absolutely.
And that's the purpose of this introduction, because all of these are different types of investments that our participants will be considering. So there might be some definitions that would be helpful later, but
absolutely.
Okay, let's not begin with those.
Yeah, well, look, I'll move on to the negotiation of the term sheet itself. So, like, what we have here is you just kind of split out the kind of negotiation, because it's flavored by the type of investor, the level of negotiation. So the most basic form would be, say, a friends and family raise, which is typically the first port of call for an early stage founder looking to get some cash into the kitty to try and scale or build out the product or the offering or the technology, or depending on the sector. So normally speaking, with friends and family, given the relationship that's there, negotiations are largely informal. But that's also flavored by the quantum, or the investment quantum, because it's typically a low amount of investment. As such, we would typically see the company driving the investment terms in a term sheet for friends and family raises. So it's the company has the opportunity here to draft a simple term sheet and say, these are the terms in which we're looking to invest or receive investment. Here's the valuation. Here's the class of share. Here's the kind of simple rights that we propose offering to the investors, the friends and family investors. And typically speaking, they're not heavily negotiated, and parties can move on quite quickly. Kind of a key takeaway from a friends and family raise is that you should avoid non-market terms. So there shouldn't be stuff buried in there that will be more the preserve of an institutional investor or a serious angel investor or family office. So it's important to keep things simple when it comes to friends and family. Moving on to the angel investors. So just to kind of explain to the group what angel investors are, typically they can kind of take a number of different forms, but typically speaking, an angel investor would be an individual, be it a high net worth individual or a serial entrepreneur, maybe somebody that has had a tech exit or an exit themselves and is looking to kind of dip their toes in again. Or some angels kind of take the form of family offices or angel networks, the likes of, HBAN, Bloom, Bool. So depending on the actual identity of the angel, that will flavor their investment terms. So if they have a portfolio of investments, they'll normally have a preferred suite of investor asks. So that will flavor the negotiation on the term sheet, because they'll say, look, these are preferred terms which we have across our portfolio. Whereas if you have an angel investor that's not too experienced, they might have the cash, but they mightn't have the experience. That will allow the founders in the company to maybe negotiate the terms that bit more heavily or more favored to the founders than if it was a family office or an experienced angel. Again, with angels, as with friends and family, it's important to avoid non-market terms, because they'll impact on your follow-on raises. If you certain rights that you might give early stage might lead to awkward discussions with the angels or friends and family when it comes to the likes of Enterprise Ireland coming in or a VC coming in. They'll ask for certain of those rights to be terminated, which is, it's more difficult to terminate something.
Could you give an example of a right, Alan, in that regard?
Absolutely. What you shouldn't be giving is a suite of consent rights or veto rights to.
What does that mean?
Yeah, so typically speaking, an investor will be a minority shareholder. Okay, the founders hold the majority of the shares in the company.
Yeah.
As such, under Irish company law, majority rules, unless there's a contract that provides otherwise.
Okay.
So the founders would typically control the board of the company, and the founders would typically be the majority shareholders. So in order for an investor to get a level of contractual protection, they need to build in, or they typically ask to build in, a suite of restricted transactions, matters that can't be undertaken by the company without the investor's consent. So they will be things like issuing additional shares, incurring borrowings above a certain level, changing the board of the company, licensing IP outside of the ordinary course of business. And they can range, Rose, from half a dozen restricted transactions to, we've seen transaction documents with 40 plus restricted transactions. So it really varies depending on the investors. But what we've also seen on occasion is clients that might come to us after they've had their angel raise or their friends and family raise, and they'll have a shopping list of these veto items that they've given to an early stage investor that's completely off market, that ends up causing a whole issue with the follow-on investor. Other items.
So, and what does off market mean?
Well, what wouldn't be, say, customary in the market. Okay. for what a VC or a series.
They'd be turned off by it in the next round.
Okay. Exactly. That they just won't do business if they're still there when they invest.
Okay. So it's restrictive. Yeah.
Yeah. Like it's one of these ones. It's not that they can't be negotiated out, because ultimately, if a friends and family investor or an angel has invested, and they realize that, okay, there's a VC that's interested in investing, they won't want to jeopardize that fundraise. But the preference would always be that you don't have to come with a begging bowl to your friends and family or angel investors looking for them to give up rights that they actually currently have in order to facilitate a follow-on raise. What you want to have is those rights are just given to the VC, and the friends and family and angel are more along for the journey, and they get to participate for their early kind of risk reward investment in the company with limited rights. A key one, Rose, as well, will be when I say kind of non-market terms are evergreen rights. Like, say, for example, if an investor says, right, I need these veto rights for so long as I hold shares in the company, that should be avoided, because an early stage investor will be diluted down significantly. So you shouldn't have, a 2-3% shareholder having veto rights or having a board appointment right forever. That's what I mean by evergreen. I mean, it's just for so long as they hold shares, they have the right. It should be for so long as they hold shares of not less than, say, 10% of the issued share capital of the company. So then those rights automatically fall away if they're diluted, and they will be diluted as further funding comes in. So then it avoids any awkward conversations or any kind of request that they fold certain rights that they might have.
Okay, so that early stage then, just a comment from one of our participants saying that even at the family and friends stage, the suggestion is that we base the share on the company valuation, that this is a big challenge. So maybe you're not going to go into that today about the basis of the valuation. But I suppose it comes into play if there's like seed round and then a subsequent round.
Yeah, well, valuation, it is obviously one that, like valuation, and I know this is kind of further on, but we might as well deal with it now that the question has arisen. But like, look, it's notoriously difficult to value an early stage company.
Yeah.
Like, you know, we all know that there's standard formulas for certain industries based on monthly recurring revenue, annual recurring revenue, certain kind of valuation multiples that just exist over millions of deals or tens of thousands of deals globally. Whereas those standard formulas just don't apply for early stage companies because invariably they're pre-revenue, they're maybe at proof of concept stage, they're at so many different stages. It's more hope value than real value.
Yeah.
So as such, depending on geographic location, there's huge divergences here between Ireland, the UK, the US. Like if we use a couple of examples here, like what we see in a seed raise in Ireland or an early stage raise in Ireland, quite a few early stage companies have difficulty getting beyond the €1 million valuation at be it a friends and family or angel raise, particularly when the likes of, say, Enterprise Ireland, as part of their competitive startup fund, have, say, they get 10% for 50,000 essentially. Yeah. So that kind of sets the tone for an early stage company in Ireland to an extent.
Okay. Yeah.
Whereas, say, stateside, it's completely different. They're slower to invest by way of equity, and they seem to be pushing far more advanced subscription agreements and safe agreements, which we'll come to in a short while as well. It's kind of, they kick the can on valuations akin to convertible loan notes. It's a future discussion. But valuation itself is massively impacted by the sector. So we're seeing quite a few clients that are maybe in life sciences or AR, VR, AI, and those sort of categories that are they're pretty hot right now. So investor appetite is at an all-time high to invest. So with that, valuations are higher for those companies at an early stage. Also, kind of founder profile has an important part to play here. So say, let's use a technology company. Founder really believes in the tech. If the founder has track record in that sector, has a decent CV, the pitch deck looks the part and stacks up, and a potential investor, be it an angel or friends of family, they kind of know the sector and they're happy, they'll be more comfortable to agree to a higher valuation. Whereas, and this is no disrespect to a kind of a first stage founder or someone that's, you know, a grad or just doesn't have that industry experience, it's a harder sell for them. It's just the nature of it. So if it's their first rodeo, the valuation discussion is always more difficult. That's the reality of it. Be it, look, at friends and family stage, but principally more so at angel and VC stage. Like we've seen some founders that have skipped their seed raise and just gone to what would be an Irish Series A and raised 10 million as their first investment round, because they have that track record.
Okay, amazing.
In that sector. So it's real finger in the air, Rose, at the best of time with valuation, and there's so many variables. COVID's obviously impacted insofar as certain sectors are hotter right now than they were pre-COVID, because some of the organic growth that the likes of communications, technology companies, or startups are seeing is above their, you know, it's outside of their wildest dreams in such a short period of time. So it's not an exact science, shall we say.
Okay. So negotiation, we've got friends and family versus angels versus Enterprise Ireland.
And I just wanted to kind of, maybe that's one from Michael, maybe to touch on Enterprise Ireland and VCs generally, just on the negotiation there.
Sure. So Enterprise Ireland has two main investment programs. There's the Competitive Start Fund, CSF. That's the earlier stage one that Alan mentioned there. So it's the €50,000 investment. As he said, that comes in two tranches. So the first is €25,000 for 5%, and then you can draw down the next 25,000 euro for another 5%. So it's 10%. It's quite straightforward. It's for ordinary shares, which is the same class of shares that the founders get.
Yeah.
In terms of negotiation, it's quite straightforward because there really isn't any negotiation on the terms. It's slightly different in that respect. What will happen is Enterprise Ireland or their solicitors will issue out just standard form documents. And then you go, you take advice on what the terms are so you understand them and how they impact you and, going forward.
Yeah.
And you issue the shares out, but it's relatively straightforward. There is a matched funding requirement for that. So you'd need to put in 5,000 euro in cash. That usually comes from the founders, and you get shares in exchange for that as well. Enterprise Ireland's standard documents have what you'll see in a lot of investments. So they'll have certain information rights. For example, they want to receive your accounts every year or information that just lets them know how the company's doing and they can assess how their investment is progressing. They'll have what's called promoter lock-in. So essentially the founders won't be able to transfer or sell their shares without consent of Enterprise Ireland. The same applies to existing loans. So if you're starting your company, you put in a director's loan just to get things going, you won't be able to repay yourself that loan without Enterprise Ireland consent. The reason for the two of those is that obviously, look at investors coming in, they're putting money into the company. They don't want that just to be, spent on repaying loans or you sell your shares because, you're the key asset of the company really, and the money is to be used for growing the idea, growing the business, getting to the next stage. They're pretty standard. They'll also have what are called preemption rights. So if you do another fundraising, they'll be entitled to buy a certain amount of shares that keeps them at the same level. So essentially, if they want to participate, they can, so that they're not diluted. They don't have to. And a lot of the time, that those rights are waived. But again, very common for investors to have those, and there's nothing really unusual. The other program then is HPSU, which is the High Potential Startups program.
Yeah.
That's for up to 250,000 euro. And again, there's a matched funding requirement. So EI doesn't just put all the money in and, in the round itself, you will need other investors. They're quite flexible. We'll go through the various instruments in the next slides, but whether that's an equity round or loan notes or safes, the matched funding can come from a variety of different forms. With HPSU, Enterprise Ireland gets a different share class. So it's called CRCPs, cumulative, redeemable, convertible preference shares. We won't get too much into it, but they're more like loan notes, which Alan will touch on later, in that they don't set a valuation on your company at that time. It's very much, they can put the money in now without having to get into that long discussion, as we were saying. And they act like loan notes in that there's an interest coupon on them. So that accrues over time and builds up, and then they either get repaid that or it converts into shares, and the shares themselves will convert when you have what's called a qualified fundraising. So essentially, this is kind of money that would get you to a large equity round where you can actually have a valuation set on the company, and then that will give you your price per share, and EI will get a discount on that price because it came in earlier. And the coupon and the discounts and the various other items, they're all set out in standard documents that, again, Enterprise Ireland will just issue out, or their solicitors. No real negotiation on them. It's more a case of, again, taking advice, make sure you understand, what's going on, and then obviously the impact of this share class and dilution on you in future. I suppose they are an institutional investor, but they're different in that sense. There's not as much negotiation. It's quite straightforward in a sense. That differs then from a VC. So with VCs, the terms can vary a lot because, as Alan mentioned, it depends on the founders, the company, the sector. Depends how far along you are as well. Are you really early stage or have you huge traction? A lot of it's up for negotiation, and certain funds just have certain asks. It's very much, this is when you need to negotiate your term sheet well, and it's non-binding, which we'll come to, so you're not bound by the term sheet, but it's very hard to move away from it once you sign it and you agree what's in there. At the term sheet stage for VCs, you'll see a few other things as well that mightn't have come up before. So this is where board composition becomes important. You know, do they get a right to have a director or an observer? So an observer can basically attend the meetings but doesn't vote on anything that's discussed at the meeting. There'll be more provisions around, you know, how you hold meetings, the minimum number of meetings you have to have. You probably have employee share option plans so that you can, you know, incentivize key employees. That needs to be agreed at term sheet stage, because that obviously dilutes people, and the VC won't want to come in and be immediately diluted. So it's usually put in just before their investment. And then the size of the plan. So, you know, is it 10% of the company is put under this share option plan? That's all agreed at term sheet stage as well. So it's important to get that right. A lot of VCs will co-invest. So depending on, again, like, you know, depending on the company and the round, if you've interest from a number of VCs, they might come in alongside each other. And really what you're doing there is who's the biggest investor in the round. So one of them might put in 70% of the money. They're the lead investor. They really set the terms, and other people follow. You know, you might have your angels follow as well, but people fall in behind them. Key takeaway there is really to get advice at term sheet stage so that you understand what you're signing up to. And again, the VC will issue the documents to you, which should reflect the term sheet. So it's important to get that right. In terms of the different ways of raising money or the structures, then Alan's going to take you through an equity investment versus a convertible loan note investment, which we've mentioned before.
Thanks, Michael. Look, in its most basic form, equity is an investment for shares by way of a price round or where the valuation is agreed. The type of equity depends on the class of shares that are issued. So at an early stage, the equity would typically be ordinary shares. As I touched on earlier, some investors look for a different class of shares with certain additional rights attaching to those shares or certain preferential rights. So that would still be equity, but they'd have a different class of shares. They'd rank equally in many respects, bar maybe liquidation or certain other preferential rights attaching to the investor's shares. Equity is still the most common form of investment that we'd see even at a seed stage, or, you know, at a very early kind of friends and family or angel stage. A lot of investors like to know exactly what bang for their buck they get on day one. What percentage of the company will they hold post their investment? The specific rights attaching to the shares, i.e. the equity, needs to be detailed in the constitution of the company, which would dovetail with the investment agreement, such that the constitution, which is filed in the company's registration office, would need to be updated from the form that would be adopted on incorporation. And then the constitution would detail whatever rights have been agreed at term sheet stage in respect of the shares. An equity raise is typically more involving than a convertible loan note raise or safer advanced subscription agreement raise, which we'll come to in a minute, because the constitution needs to be updated, because it's priced. But it is still the kind of go-to for a lot of early stage investors if valuation can be agreed. So that's a big if as well. So it does keep things simple because people know what they have. It's not a hypothetical conversion at a future funding raise or a future event or a future point in time. But having said that, Rose, over the last, I guess, 36, 48 months, we're definitely seeing more of a shift towards the use of convertible instruments. And it can protect a founder as well from them kind of underselling the value of the company. So say, for example, if an investor or a founder agrees, say, to a 2 million pre-money valuation, and then the company goes gangbusters really quick or in short order after that raise, they might have given away too much equity too soon, which they'll regret further down the track. So to kind of ameliorate that, or to kind of counter that, convertible loan notes could be a course of action or a preferred course from founders that want to kick a valuation discussion kind of down the track or kick it into touch until a follow-on raise. So essentially what a convertible loan note is, it's a loan like any loan that typically has an interest coupon. And in the market, what we're seeing is an interest rate of between 2 and 10%, depending on the terms, depending on the amount. But that loan is normally repayable within a 5-year period. What the founder needs to protect against is getting a loan that is repayable too soon, because they won't have the cash available to redeem the loan if the redemption date is too soon. Also, if the redemption date is too soon, it will impact on fundraisers with Enterprise Ireland, because they won't invest in a company that will in any way seek to use their investment monies to redeem or repay an existing loan. So it need to be kind of clever on it as well, that the redemption date is pushed out on a convertible loan note to align with, say, Enterprise Ireland's funding and Enterprise Ireland CRCPs, as Michael touched on earlier. The convertible loans convert typically on what's called a qualified financing. So a qualified financing is invariably a material funding round that the company undertakes that puts a defined valuation on the business. And the convertible loan would normally convert at a discount to that valuation to, I guess, reward the earlier stage risk for the convertible loan note investor coming in before the material priced funding round. Key takeaway from us on convertible loan notes, I know I touched on this earlier as well, Rose, is like what's market. Like the interest coupon should be within reasonable parameters. And as I said, it can range from 2 to 10%. The conversion discount, we see all kind of shapes and sizes and conversion discounts, but normally the range would be between 10 and 25%, depending on lots of different variables, but that would be the range. The type of shares that the loan converts into would typically be the class of shares that are issued in the next round. So they're either ordinary shares or they're preference shares that will be created as part of what would hopefully be a VC round, if it's the convertible loan notes issued as part of, say, an angel or pre-seed raise. So yeah, look, we're seeing them very regularly. They're quite often used as bridging finance. So say, for example, if the founders are trying to close out a priced raise, so an equity raise at a valuation, but they're going through various processes with various kind of institutional investors, they might need cash in the immediate term or in the shorter term. So you could have a short form convertible loan note instrument as a form of bridging finance that would bridge the funding requirement between now and when the material transaction would close. And the convertible loan note investors' reward for doing that is that they get a discount conversion, discount price to the price per share that's issued on the actual principal transaction. Just last point to note on convertible loan notes, 99 times out of 100, they're unsecured. They're an unsecured debt. And so, you know, any founder or any investor that would seek to have a guarantee or have them secured against the assets of the company or the IP of a company should be resisted. The only time that loans should be secured in a startup, in the startup sphere, would be the likes of venture debt finance from, say, Silicon Valley Bank. And that's very much further down the track when you're getting different kind of institutional bankers providing forms of loans to companies. But if in the context of an early stage company that is obtaining convertible loan notes or issuing convertible loan notes to investors, they should not be secured, because if you secure them against assets of the company, it will cause more issues on the follow-on raise, which we've seen in the past, and it's not pretty. Moving on then, just on to Michael then on the safer, simple agreements for future equity.
Yeah, so I suppose these are really born out of the complications that arise on equity rounds and loan notes. As you can tell from Alan running through it there, there's a lot to consider, there's a lot to negotiate. The SAFE then is a called a simple agreement for future equity. It was designed by Y Combinator, which is a famous accelerator in the US. And it was designed really to help their portfolio companies who were, post their accelerator trying to raise money from investors, just to do it more quickly and to do it cheaper. So they're very much a template type of document, and they share some characteristics with loan notes in that it's an agreement to invest money now in exchange for the issue of shares at a future date. That future date is the price to equity rounds. Similar to loan notes, you have a round that places a valuation on the company, and the SAFE instrument would convert at that time into shares. There's really only a handful of negotiation points, and that's, is there a discount? Usually there is. So what's the level? Again, around the kind of 10 to 25% is what we'd see, usually around 20 with safes. And is there a valuation cap or not? So a valuation cap is essentially agreeing when you sign the safe what the maximum valuation of the company is. So it gives the investors comfort that, look, you're investing now when the valuation's obviously very low, but if it really takes off, the valuation could skyrocket, and then they'll convert at that much higher valuation. So you're agreeing now that there's a kind of a ceiling on what the valuation is that they'll convert at. They're really the only two negotiation points, aside from how much they're going to invest. It is quite straightforward in one sense. They are becoming more adopted in Ireland. We're seeing them more regularly. Also seeing a few VCs use them if it's very early stage fundraising. It does speed things up. It's really about getting people comfortable with them because they're a US style document. And if you're an investor, they don't come with various rights like information rights and preemption and all these other things that they'd be used to getting. You can have principally preemption rights, say, where they get to follow their money next time. You can have that in a side letter so that they do get those rights. But look, it kind of depends who you're raising money from and whether they're comfortable with this, much more streamlined type of investment. But it is becoming more and more common. Again, then another one that's more of a US document. There's an advanced subscription agreement, it's called, another short form, kind of like 2-3 page documents, similar to a safe in that it's very streamlined. It's more of a UK document, but again, it's an agreement that they invest now and you'll issue shares to them at a future date at a discount. And the future date is, again, when you have this equity fundraising that sets the valuation, sets the price per share, they get their discount against that. One difference is that there's a long stop date in an advanced subscription agreement. And what that means is that if you don't have your financing event, say within 6 or 12 months, then the advance of it just automatically converts at an agreed valuation. You'll agree that it's the cap again. As with safes, it's not a loan, it's not repayable. If there's a sale of the company before this conversion event happens, before you raise money, then they're entitled to part of the proceeds as well. That's all addressed in the document. And if there's a dissolution event, the safe gets a return of money as well. Really, if it's a dissolution, there's probably no money to share, to be honest. It's probably going to go to the creditors. But both of those are designed just to be very straightforward, very simple. It's really about getting the investors on board and whether they're comfortable with that and the fewer rights than what they'd normally get. But it's a bit more company friendly and should be lower on the cost side as well in order to implement it. And then we'll take you through the kind of the principal points that are negotiated maybe a bit more heavily on at a term sheet stage.
Thanks, Michael. Look, I know we touched on it earlier on the valuation piece. Valuation is notoriously difficult for early stage companies, just settling on it. There are certain kind of sweet spots, as I touched on earlier, from an Irish VCs or Irish investors perspective at different levels. I know I touched on Enterprise Ireland CSFs, which you get 10% for 50,000, as Michael touched on there as well, in 225k tranches. That somewhat sets the scene for a company at an early stage for an equity raise. As I mentioned, it's massively impacted by whatever sector is hot at any given moment in time. It's impacted by the investors' appetite, but it's also impacted by the founders' experience and the stage of development that they're at. If it's a case that they have put 3, 4, 5 years or a long period of time into developing the concept before incorporating, such that, you know, shortly after incorporation, shortly after receiving funding, they'll be ready to go to market, then it's a completely different proposition that to a company that is literally fresh out of the box, real kind of concept stage as opposed to development stage. So these are things that there's no, you know, it's not black and white, it's very much gray and blurred outlines. But what, you know, we'd have so many conversations with our clients as to kind of what would you see in the market as a kind of rough valuation, and there's kind of certain guiders, but again, it's down to negotiation with the investor, and no two companies are the same, unfortunately. Another one that we see is, look, founder dilution is something that can be a bone of contention. Essentially, it is a necessary evil. So if somebody invests in your company, regardless of the investment instrument, they're doing it in order to get a return, be it getting skin in the game by way of equity on day one, or getting skin in the game by way of a convertible instrument like convertible loan note or Enterprise Ireland CRCPs or advanced subscription agreement or the SAFE agreement, as Michael touched on. So on this, what we always suggest to our clients is that get a handle on the level of dilution you're willing to, I suppose, agree to or suffer. Know kind of what impact any future instrument has on your holding of shares in the company. And this is more important. Like, it's very clear, obviously, if you issue ordinary shares, 10% of the for 10% of the company, you remain 90% shareholder. That's black and white. But if, for example, you have 3 co-founders at 33% each, how much dilution are they willing to kind of accept in the short term to get the business off the ground? How much then further dilution are they going to accept as they go through an Enterprise Ireland raise or a VC raise, such that when it comes to exit time, what percentage of the company will they hold? So these are things that they should be modeled out. Obviously, things change.
Put that into the into this agreement, Alan, initially. So if you have 3 founders setting up like that, you'd agree from the outset how much you're willing to dilute, or
no, it's more. Say if you've 3 founders, like, say ultimately there's dilution at every turn. So, like, say for example, founders should kind of have a consideration and discussion between them, and just kind of general consensus as to, you know, what sort of exit are they looking for, what sort of raises are they looking to do, what sort of dilution would they be willing to accept. So ultimately, if a company sells for 10 million, but the founders hold, say, 5% or 10% between them, and they're after putting their heart and soul into the business for 5 years, is that an acceptable return to them? So from an investor's perspective, the investors will want to make sure that the founders have sufficient skin in the game to drive the business forward, because the investors provide the capital, but the founders provide the sweat. So it's just that it's an important one that founders have a kind of a handle on what things look like on day one and what things could hypothetically look like as they go through the mix. These things change because they might get a different term sheet. They might get to do a convertible raise when they thought they might do a priced raise. But it's just one to kind of be, I suppose, somewhat aware of, as opposed to it being an exact science. But it's more important if there's multiple founders in a company, because their starting position is that bit lower, albeit, you know, you'd think that with a number of co-founders, the ability to drive the business forward between them is increased. But because if they're starting on equal terms, and there's 3 or 4 founders, it's 33% to 25% on day one, the only way is down. So they just need to be mindful of that fact. Another item just that I have on the list here is founder vesting or clawback. And I don't propose getting into the weeds on this one, Rose, too much, but essentially we're seeing more and more early stage investors looking for a level of founder vesting or clawback to be built into their investment documents. And in its most basic form, say the founders hold, two founders, 50% of the company each, right? If there's a clawback provision in there, they still hold the shares. It's just that in the event that they leave the business of the company, be it as a good leaver or a bad leaver, then depending on the date that they leave the company, a certain portion of their shares will be subject to being clawed back or reverse vested and given back to the company. And the main rationale for this is that if you have a couple of co-founders and say one of them's the CTO and the CTO leaves before the company is exited, the other founders will need to entice another CTO to join them.
Sure.
So how do you do that? And the way to do that is by offering some skin in the game to a CTO. The only way to do that is by way of shares. And why should you leave an exited founder on the cap table and then dilute everyone else in order to carve a new CTO in? So essentially, look, there's no black and white definition. There's certain kind of definitions for good leaver and bad leaver. Good leaver would typically be if a founder was incapacitated, was due to illness or an accident or something along those lines, or if they died, for example, God forbid. A bad leaver would typically be if a leaver was dismissed for cause, gross misconduct, fraud, breach of a non-compete, or something along those lines. So typically speaking, a good leaver gets to retain the portion of the shares that are vested, or the company has an option to buy those shares at market value. And the shares that haven't vested would be clawed back for nominal value. In the event of a bad leaver scenario, both vested and unvested shares will be subject to nominal value transfer. It's one of these ones that quite often it's contentious amongst founders, inter-founders and investors. If founders think, this is my company, I've earned it, these are my shares. But essentially what it is, it's to help founders or protect founders against other co-founders that one of them doesn't hit the high road. But it's also to protect the investor that has invested pursuant to a business plan that has key founders and key team members allocated with equity resourced or distributed amongst them. If one of them leaves, it kind of changes everything. So it's to incentivize a founder to stay for the journey or disincentivize them to leave for the greater good. So look, they're often misunderstood. It comes down to the legals and the detailed drafting, which I won't go into now, but ultimately founder vesting can be a bone of contention, but it doesn't need to be so once the manners are put on founder vesting terms in term sheet stage.
Okay, so we just have 12 minutes left, Alan, and we've got a couple of questions to answer as well. So if you'd like to kind of skip through another couple of bones of contention that we should look out for, and then we could go straight to the questions.
I think they're the kind of principal bones of contention.
Okay.
What I just wanted to maybe touch on, and this is one for Michael, we were going to maybe just chat about just exclusivity real quickly, and costs, if that works.
Sure.
Yeah, I'll just say like a few quick words on it. Term sheets are usually non-binding, so you're signing the document, but you're not actually bound to issue shares or to take in the money.
That sounds a bit strange, doesn't it?
Yeah. Well, look, it's really a roadmap as to look, this is kind of the headline terms, and if we're agreed on these, then let's actually get into negotiating it. Now, it is really important that the term sheet sets out, what's agreed commercially, because that's what everyone will expect to appear in the documents, and you're negotiating the finer points, not going back over how much money or how many shares. Or is it a loan note? Is it a whatever? So it's important to get it right. There's exclusivity and costs, and governing law are always binding. So it'll be Irish law. That's easy if it's an Irish company, Irish investors. Exclusivity. So investors will want to know that, look, you're not out talking to 50 different people, a few different funds, and they're there, looking into the company, due diligence, checking your tech, your IP, your documents. There's a bit of time involved, and so there's cost involved. So they'll probably just want, maybe 4 to 6 weeks where you agree just to exclusively negotiate with them.
Okay.
If nothing comes of it, fine, but it's kind of, just to give them comfort that it's not, 4 weeks in and then you go and sign a term sheet with someone else and they invest, Cost really depends. And the cost, I mean the cost of the transaction, so preparing the documents and actually, getting it closed. With friends and family, with angels, it's usually very light touch anyway, so costs are lower, and usually the company gets the documents prepared and the investors look after their own costs if they get a solicitor involved. When it comes to EI will look after its own costs and the company looks after its costs. And then when it comes to VCs will usually look for the company to pay the VC's cost of investing, or the legal costs anyway. For that reason, it's important that you actually get a fee cap agreed so that you won't go above X. It also helps expedite the deal, so helps speed it up because they know there's a cap. We're not just going to go on forever looking into things or going back and forth on negotiation. It does help people, but it also helps you to plan. Like for ourselves, what we do is once the term sheet's actually agreed, so we'd help you up to that point, no problem. And then once we have a clear view on what's involved and structure and all the rest, we'd set out a scope for clients and an estimated fee quote so that you've full visibility. And that's probably the best way to do it. So I'd say just keep that in mind as well. That's principally it then. If there's any questions.
Great, thank you very much, Michael and Alan. Just on the costs, then would you, if we were to go to Wallace Corporate Council, for example, and we were, a lot of the participants on the call mostly are raising money from friends and family. So if we were to go to you, would you provide us with a sample term sheet that we could base the agreement off? And then what type of costs would be associated with the friends and family from there on?
Yeah, sure. Yeah. We could provide a term sheet that would be, pretty straightforward that we'd see for early stage investments. Once the term sheet's agreed, like there are a few, how many people are involved or a few other things that we won't get into to complicate it. Yeah. But as soon as we have a clear view of what's required, then we'd set out a scope of, these are the handful of steps and documents, and we'd give you an estimate as to cost. So that's all in advance, before we actually get into any of the work or any expenses incurred by the company. So you've got full visibility.
Exactly. And just on it there, Rose, as well, like, look, regardless of what firm any of the attendees on the call would engage, it's important that they try and either negotiate a fixed fee or fee cap, or ultimately the kind of view that needs to be taken by solicitors for early stage companies, that it's a lifestyle, or it's a life cycle view. So from our perspective, we have the ability to take a view where we'll advise a company on the earlier range or rounds in order to build a relationship with the company. If the company scales, they'll have to keep coming back. Legals get ever more complicated. We want to be part of the journey from seed right through to exit. That's people will see that from the kind of the profile of the clients on our website. So it's about the journey here. It's not about fee gouging day one, and that's absolutely not how we operate. But so, as Michael said,
just to get an idea, though,
it varies. Like, say, for Enterprise Ireland transactions, like say a CSF raise, like fixed fee, typically speaking, say would be about €1,500 for a 50k raise with Enterprise Ireland. Whereas HPSU with Enterprise Ireland, and I kind of use these ones because the terms are fairly fixed, but there are variables as well, because EI can elect to co-invest and use a different form of investment, subscribe for the same instrument as another investor. So they kind of range from the starting point for a HPSU would be around €2,500. So that's, for a 250k investment. So they're real broad range. VCs, because at that stage, there's so many variables in the mix, it's very difficult to know until term sheet is actually signed. But for friends and family, Rose, you'd be kind of looking at ballpark 2.5% or 2% or thereabouts of funds that are raised. But it depends on, as Michael touched on, how many investors are involved. So if you had 50 friends and families, you have to have 50 investment documents, you have to have 50 share certs. It's multiplied out. Whereas if you've two friends and families and you have one investment agreement that's short form, it can be done in an expedited manner. So our costs are less, our time input is less, and it's more efficient and effective.
Okay.
But they're kind of ballpark figures. But like the way we
That's
operate
helpful.
is term sheet being agreed is fundamental, because then everyone has a roadmap, and that's the kind of platform.
With that in mind, one of the participants has said that she's invested in a consultant to create a data room, and is that an advantage? You know, that I suppose that all of the information is available to any of the investors, or you know, that the people aren't going back and forth looking for information.
It's important that an NDA would be put in place in advance of any information sharing, but creating a data room is, I think it's a really good step, because it's literally you can share the relevant information, click of a button, as opposed to attaching emails, and then you know that there's consistency of sharing of information between investors. But if there's any sensitive information, such as any particular IP or any secret source, then either redact the information or absolutely get an NDA signed before any sensitive information is released. That's the key. That's very fundamental.
But it's a good idea anyway. Great.
Massively so. Great idea.
Okay, and then is there a preferred way to set up the initial share price, total number of shares, issued number of shares to founders, etc., for future fundraising, if you're not seeking investment on day one? For example, go ahead. Sorry, Alan.
Yeah, like our preference is always to kind of not issue necessarily 100. Say if there's two founders and 50, if you issue 50 €1 shares each, they're 50% shareholders. Our preference would normally be to issue out lower denomination shares and higher number of shares, such that you can get very specific percentages of holdings without having to do subsequent share splits and divisions.
Would you have an ideal number there? Even when you're incorporating?
Typically cent shares.
Pardon?
Typically 1 cent shares.
1 cent shares. And how many?
We'd normally kind of split it out if there's two founders to maybe either 5,000 each or 500 each. Thereabouts. Yeah. There's no, long story short, there's no right or wrong way to do it. But it's just, it makes it slightly easier as you go on. It will most likely avoid another shareholders resolution and CRO filings to subdivide the shares. So you might as well do it on incorporation as opposed to subsequently.
So 10,000 shares at a cent each.
Yeah.
Okay, just a couple of minutes left. And would it be possible for us to get a sample term sheet? Or would that be as a follow-up for participants?
Yeah, absolutely.
Yeah, great, super.
Look, and just on that, Rose, I need to flavor it by saying, look, one template can't be all things to all men.
Of course.
It will give a flavor, because there's a divergence between a term sheet, say for the 4 main instruments. So the equity term sheet, convertible loan note, advanced subscription agreement, and SAFE. They would be 4 different term sheets. But what we could do is provide a term sheet maybe for say equity as a starting point.
You know what might be even more helpful is maybe just like a checklist for each of those.
Okay.
If that might be helpful for participants, so that we know what to look for when we're going about setting up the term sheets, or we know what to consider in advance of engaging in this. So then one quick last question, but it's probably a long answer. And you may say it depends as well.
This one to Michael.
Okay. What are the pros and cons of SAFE versus convertible loan notes for founders? So from the founder perspective.
I'm conscious we have just 1 minute left. So, SAFE's very standard document, really no deviation between them. Loan notes, not so. It does depend on commercials and what the conversion mechanics are and the rest. With SAFEs, it's not a loan, so not repayable. With loan notes, it obviously is. Loan notes have interest because it's a loan. SAFEs don't. SAFEs convert in a very formulaic way, because the SAFE's a template document. The loan note, it really depends what you negotiate. Is there optional conversion? Is it just a conversion event? Various other things. It's So basically not repayable, no interest, more straightforward conversion is what I'd say for safes.
Okay. All right. Well, look, thank you to both of you, Alan and Michael, for your time today. If anybody wants to reach out to you, your website, I think, is corporatecouncil.ie. Is that right?
Correct.
Great. And as always, we'll send out the recording of this to all participants and people who registered for today's webinar. You're coming back to us, I think, next week or in a couple of weeks for the next part of this. So we look forward to talking to you then. And thank you, everybody, for participating today.
Well, thanks, Rose.
Bye now.
Thanks very much.
Thank you. Bye.
Bye-bye.